Hi everyone. Now, the reason why I have labeled this the key to building strong foundations is whenever I come across a number of teams or SMEs, I find that they've got very good updated knowledge, but when you go straight down to the foundations, that's where they lack. And as soon as I, scratch the surface, I realize that the foundation is not there. Hence, I'm creating this video for everyone to have a look at their own view as many times as they want, just to build those strong foundations. As CDD professionals, we need to have strong foundations. So let's start with the definition of financial crime. It is important to note that financial crimes refer specifically to crimes against property. Financial crime refers to a wide range of criminal offences, including money laundering, terrorist financing, bribery, corruption, proliferation, cyber, financial crimes, sanction violations, various other types of fraud, and other types of crimes against property. Now, financial crimes involve the conversion through lawful means, the ownership of another person's property into one's own. Yes, it's very basic, I know. In recent years, financial crime in all its forms has become a global phenomenon involving trillions of dollars, with new technology coming into play and making transfers of value across jurisdictional borders. Quick, efficient, and anonymous criminal activity has become incredibly profitable and also highly manipulative of slow-moving regulatory change, legislation, and enforcement response. That's why these foundations are very, very important, because what happens? You go back to the foundations, back to basics. You go back to why are we doing what we're doing? Why is this happening? How is this being transferred into criminal property? It's also important to note that financial crimes impact every one of us in very real terms. Even if you have not been a direct victim of money laundering, fraud, identity theft, or scam, whatever, financial crimes result in raising the cost of banking services, new legislation, and strengthening of infrastructure to protect society from crimes billed to taxpayers. That's us. It impacts the risk ratings of individuals, corporations, countries, which in turn makes their access to money more expensive. When access to money becomes more expensive, it results in degrading the ability to conduct trade. Economic activity suffers as a result. Financial crimes, if left unchecked, have the power to endanger commerce and economic activity and choke out the very lifeblood of future wealth creation and prosperity. So let's go back to what is money laundering. I know it's basic, but let's go back to it. So as far as you know, and as far as everyone's been taught, is most people have the idea of money laundering is, when asked, people tend to describe it as turning dirty money into clean money, turning money from illegitimate economy into money in the legitimate economy, disguising criminal money. All these descriptions are right in as far as they go, but they fail to describe the real nature of money laundering and how much global financial services industry is threatened by it. So, what is money laundering? Quite simply, money laundering occurs every time any transaction takes place or any relationship is formed that involves any form of property that has come from any crime. The legal definition is whoever directly or indirectly attempts to indulge or knowingly assists or knowingly as a part of it's actually involved in any process or activity connected with the proceeds of crime and projecting it as it attained property shall be guilty of the offence of money laundering. So how is money laundered? Having identified in broad terms what money laundering is, you must understand the money laundering process itself. In its broadest sense, a whole range of professionals are usually required to assist in the money laundering of proceeds of crime. These professionals may include bankers, trustees, lawyers, accountants, brokers, and other such professionals. Some professionals knowingly offer laundering assistance. Others provide their services without due regard for what they may be facilitating in. And that's the latter that we are addressing today. Some professionals knowingly offer laundering assistance. Others provide their services without due regard for what they may be facilitating. And it's the latter that we're dealing with today. Now, money laundering may take a variety of forms. Criminally derived property can also be laundered by using an almost infinite number of methods involving, where necessary, all financial services and products. Traditionally, it has been commonly accepted that money laundering process comprises of three main stages. You got it, placement, where the cash is derived from criminal activity and is infused into the financial system. Layering, which usually involves a complex system of transactions designed to hide the source and ownership of the funds. And integration, which at this stage is laundered funds are reintroduced into the legitimate economy, appearing to have originated from a legitimate source. The three-stage model of money laundering is a convenient way of describing the activity, but it does not always reflect the reality and can be seen as a little too simplistic, and can be seen as a little simplistic. Firstly, the three-stage model of money laundering assumes that all crime generates cash, which is then deposited to some way into the financial system. This is not true. In fact, any form of property can be laundered. The nature of a property resulting from a crime can change. It may start as money in a bank account and then turn into units in an investment fund, real estate settled into a trust, or even a yacht. The point is, when we talk about money laundering, we are not simply talking about money in the form of cash or deposits due to bank accounts. We are concerned about the laundering of criminally derived property in whatever form that the property may be. Another common myth encouraged by the three-stage model is that money laundering can be identified as some sort of set process in which it is possible to identify when it is happening. At each step of the way, another common myth encouraged by the three-stage model is that money can be identified as some sort of set process in which it is possible to identify when it is happening at each step of the way. There are a number of crimes, including almost all financial crimes and fraud, which result directly in benefits that are already within the financial system. For crimes of this type, placement is irrelevant. It's already there. Unless you appreciate the limitations of the three-stage money laundering model, there is a danger that you will fail to identify money laundering activities simply because what you see may not fit with what you expect money laundering to look like. It is important that you keep an open mind about the types of clients and relationships that pose the risk of money laundering. The harsh reality is that it is not necessary to successfully launder money by managing an entire laundering process or any particular stage of it. In order to commit a money laundering offence, all that is required is a contribution to the process by dealing in some way or another a person's benefit from crime. You are entitled to assume that clients of your organization are honest unless and until information comes to your attention that leads to you either know or suspect criminality. So, what do you do to report any knowledge or suspicion that you formulate during your work? So, the formulation of suspicions generally follows the pattern of comfort, concern, and suspicion. So, for example, an event may happen within a normal client relationship which triggers a concern in mind of an individual. Once the concern of the individual comes, the individual should first of all analyze the available customer and business information, discuss concerns with colleagues and managers, make discreet inquiries of clients without alerting them to the nature of the inquiry, and follow this process following this process there will be either a return to the feeling comfortable with Following this process, there will either be a return to feeling comfortable with the client if concerns are allied, or concerns will remain or shift to being suspicious. If the individual remains concerned, then further discreet inquiries should be made or the matter should be referred to a manager. You are not expected to actively search for information that may lead you to become suspicious. Instead, you must know your clients, remain alert, consider whether any activity is usual or unusual or potentially suspicious, then report when necessary following your organization reporting process. Bottom line, does it make sense? Money laundering activity is usually noticed in the following situations: where there is no legitimate rationale for the relationship, where the behavior of the client is suspicious. For example, the client puts great pressure on you for their instructions without providing you with all the answers you need, where there is unusual or irregular activity when compared with the historical pattern of the relationship activity, what is known about the circumstances of the client, and what is known about the commercial objectives of the relationship that would make you feel that it does not make sense. Know the purposes of the customer relationship. That is the key. So again, back to basics. Many people mistakenly believe CDD is just about establishing client identity. No, it is not. It's verifying the identity of the client. That is an important part of CDD. However, CDD also includes capturing a range of additional information. Each relationship a business has unique. So each relationship a business has is unique. As a result, normal activity in one relationship may appear to be highly unusual in another. So the more you know about your clients, the better place you will be to identify unusual and potentially suspicious activity. Following CDD information generally refers to the key parts of the client relationship. For example, who is the client? Here we are looking into verify their identity. Here we are looking into verify their identity. Are they who they say they are? For example, what is the common rationale for the relationship between the client and the organization, or what the client is seeking to achieve? Does it make sense? Again, what is the client's source of wealth? In other words, what is the provenance of the funds? Do you know where they come from? An inheritance or a business activity, or represent the proceeds of an asset sale? What has been the historical pattern of the client's relationship activity with the business? And has it been consistent with what was expected at the outset of the relationship, the expected activity versus actual activity? Is the current or proposed activity consistent with the client's profile and the common objectives? There are four main ways of benefiting from CDD information. One, to obtain it and use it to decide whether to take on a new client. Two, to predict the normal pattern of activity that you expect to see within a relationship, given what you know about the client and his or her objectives. To actively use the information to evaluate the risk level that the composite of the several pieces of information about the client present to our business relationship and allow us to build an appropriate level of diligence to manage the risks in the relationship. Number four, to actively use the information and appropriate customer risk categorization to facilitate effective monitoring of client relationships for unusual and potentially suspicious activity. Now, CDD is a dynamic process that involves analyzing activity that you see against the information that you have, and if it is unusual, deciding whether to seek additional information. It requires you to be ever vigilant and to apply what you know, the monitoring of all client relationships. Okay, so let's look at the risk-based approach, which is part and parcel of what I've put in as a snippet there. Increasingly, regulators and international bodies such as the Financial Action Task Force and European Union and local regulatory bodies in every jurisdiction are promoting risk-based controls for AML. A risk-based approach means that firms ensure that their systems and controls are proportionate to their particular risks of financial crimes. The rationale for a risk-based approach is simple. Firms have finite resources, and those resources should be targeted at higher risk areas to ensure the maximum benefit. The aim of the risk-based approach is to promote a move away from a one-size-fits-all approach to AML procedures and to assist in the objective of preventing money laundering. A risk-based approach acknowledges that risks faced by firms vary widely across different jurisdictions, product and customer types. In response to these variations, a risk-based approach will enable senior management of a firm to create their own approach to systems and controls in a least prescriptive manner. This approach will result in a more efficient set of procedures, focusing greater effort on higher risk areas. A risk-based approach will inform every aspect of a firm's AML systems and controls, but is of particular importance for account opening procedures and CDD monitoring. The key risk factors are considered when formulating a risk-based approach include product, distribution channel, jurisdiction, customer type, volume, and size of transactions. Once the risk factors have been assessed, controls should be designed and implemented to mitigate these risks. That it means, so you've had the inherent risks, then you have the control effectiveness come in, then the residual risks need to be monitored. So the UN Security Council Counterterrorism Committee provides a comprehensive description of terrorism financing stated here. Simply put, terrorists need money to operate. Without funding, they cannot purchase. Without funding, they cannot purchase weapons, equipment, supplies, or services. Slightly more complicated is that where the funds come from. The source of funds may be illicit or illicit, Um, and the funding often takes the form of multiple small donations rather than one large sum of money. Terrorist groups may directly or indirectly be linked to organized crime groups and engage in criminal activities, including drugs or arms trafficking, extortion, kidnapping, ransom, kidnapping for ransom. Terrorism financing is a global phenomenon that not only threatens member states' security but also focus or undermine can also undermine economic development and financial market stability, and is therefore a paramount importance to stem the flow of funds to terrorists. Terrorist organizations require money for many purposes, including recruitment training, weapons, travel, materials, and safe houses. Major terrorist acts such as Major terrorist acts such as 9/11 or the Madrid bombings needed a significant amount of time, effort before they could be carried out. However, the actual financial cost of the individual uh, terrorist act itself may be surprisingly low, which brings challenges in terms of detecting terrorist financing. This, in contrast with other types of criminal activity where financial gain is generally the ultimate objective, terrorist organizations all require support in order to achieve their aims. Like any criminal organization, they must be able to build and maintain an effective infrastructure. Traditionally, AML efforts have concerned the criminalization of the laundering of proceeds of different forms of laundering criminal conduct. Terrorist financing is now a very serious threat to financial services, businesses, and must be taken as seriously as money laundering. Both have a number of features in common. Even in cases where benefit of underlying criminality is being laundered, the laundered proceeds will eventually go to fund future or prospective criminal acts. The destination of money used to support terrorism has to be disguised in the same way that the source of laundered funds may also be disguised. Both require the assistance of the financial sector, even where the source of funding. Even where the source of funding for terrorist activity is lawful, terrorists would nevertheless attempt to disguise it in order to preserve future funding. Many of the techniques used to describe the destination of terrorist funds are identical to those used to disguise the source of proceeds of crime. The difficulty comes in protecting business against property that may be derived from a lawful source, but then that may be destined to fund future acts of terrorism. You must be alert to the possibility that property that you handle may at some future time be used to fund an act of terror. The key prevention to both money laundering and terrorist financing is the adoption of adequate CDD procedures, both at commencement and of every relationship and on the continuing basis. The key to the prevention of money laundering and terrorist activity is the adoption of adequate CDD procedures, both at the commencement of every relationship and on a continuing basis. That's account opening and monitoring, basically. The regulatory framework for AML has been adapted to incorporate counter-financing of terrorists. This adaptation intensified after 9/11 attacks on US and subsequent London, Bali, Madrid bombings. More recently, following the Paris terror attacks in 2015, the European Commission presented an action plan designed to strengthen the fight against terrorist financing, including measures to prevent movement of funds and to disrupt revenue sources. It also included proposals for EU legislation for a new EU legislation to harmonise criminal sanctions of money laundering. All money laundering involves illicit funds by definition. The common element between money laundering and terrorist financing is the money is on the move. Final slide, economic sanctions that have been the international community. Economic sanctions that have been the international community's response to ethnic conflict, human rights violations, drug trafficking, state-sponsored terrorism, and nuclear proliferation, as these events adversely affect the stability of the international system. The term proliferation usually refers to the spread of nuclear weapons, fissionable material, and other weapons applicable nuclear technology, along with other mass destruction weapons systems, and sale of information on nations not recognized as nuclear weapon states by the Treaty on the Non-Proliferation of Nuclear Weapons, commonly known as the Non-Proliferation Treaty, or NPT. Until the mid-90s, sanctions were mostly comprehensive, with underlying government of a nation could be forced to change behavior if the international community could act together to weaken the economy of a target nation. Examples include Libya, North Korea, and Ivory Coast, Cote d'Ivoire. In more recent years, sanctions have been used as an instrument by the international community to force change on nations as evolved as a more targeted approach focused on individuals, government officials, corporations, industries, activities, and rebel factions such as Angola, Sierra Leone, Syria, and the Taliban. Targeted sanctions take many forms, like travel bans, asset freezes, arms embargoes, or targeted sanctions, which may include such measures as boycotting of commodities, including petroleum, diamonds, timber, charcoal, and luxury goods. There's diplomatic sanctions, including limitations of travel for diplomatic and government officials, thereby restricting their ability to represent their nations meaningfully and international forums. Financial sanctions, which have been most persuasive and effective targeted measure. Financial sanctions, which have been the most persuasive and effective targeted measure, and includes asset freezes of central banks, Libya, for example, or foreign wealth funds, like, for example, in Iran, bans on financial and investment services, like North Korea. While this evolution from universal to targeting of sanctions has made it more of a flexible tool, sanctions have now begun to resemble more and more instruments of universal governance rather than a foreign policy tool. Along with evolution, there's also been a change in the challenges faced through sanctions evasion attempts. While comprehensive sanctions are implemented and evaded, many governments' targeted sanctions are aimed at industries, activities, individuals. While comprehensive sanctions are implemented and evaded, mainly by governments, targeted sanctions are aimed at industries, activities, individuals, and non-state actors, and therefore it has disparate individuals, entities, and non-state that are forced to adjust their behavior in response. There is always an incentive to keep trading with sanctioned parties, and even more interestingly, sanctions themselves may create the opportunity for sanctions busting activities because sanctions tend to limit supplies and thereby make trade in banned commodities even more lucrative.